check out the episode we recorded today regarding HELOCs, home equity line of credit. I texted you a couple weeks ago about this. More information for you is recorded right there for you. Check it out. Any questions, feel free to give me a call. All right. Talk soon. Hope all is well. Okay. Welcome. It's Lawrence King. We're building top agents. We're back with another episode. I am here with my special guest, Jordan Syers. You are a mortgage broker. Is that correct?
Yep.
Also an investor.
Mhm.
Jordan, tell us a little bit about you. What we cover on this show is pretty much we go over everything real estate, whether it be mortgages, properties, Airbnb, all the good stuff. So tell us a little bit about you, who you are, what you do for a living,
Yeah.
besides just mortgages, obviously. But talk to us, Jordan. Tell us welcome to
Yeah.
the show.
So, bit of background on me. I actually started in the mortgage industry. I started in when I was 18 years old. I just met the right people, fell into it. I was going to college. And I ended up getting my license by built. Can you hear me?
Yep, I thought we might have froze here, but we're good.
Okay.
We're good.
So yeah. And so from there, I built I took coaching programs, won Rookie of the Year, a few awards when I first started in the industry, and then built a 25 transaction a month business. Was making some credible money by the time I was 21. Decided that this was going to be making me way more money than my college degree. And I stuck with it. And eventually I became a director for Nexa as a whole. So I helped actually I want to say put together the company, but help it run. And I helped put together their training academy more than anything. And that training academy, I built it up to about 500 LOs. So I think currently now there's about 500 LOs. We broke off from that and started our own team now. And in between all that, I also invested in property and started other businesses. Like we own credit repair companies, different companies associated with real estate, Airbnb arbitrage, you name it. I've probably tried it in some way or another. I even, go into tax sales and buying properties. I mean, we could talk about doing that. I've gone to counties and bought tax sales and built portfolios. The highest portfolio amount I've ever owned was about 98. And I did that all from starting with mortgages.
Now,
right?
is that single family or is that multifamily?
Is a mix.
Okay,
So it was a
mix.
mix. So 98 doors. So
okay, 98 doors total.
Yeah.
Okay. And basically for everyone that's out there, because we have a couple people that's listening that are not in the real estate field, LOs is loan officers, correct?
Yeah.
Got it. And then Nexa is a mortgage brokerage.
Yeah, it's a mortgage brokerage. Basically, think about it as insurance. You have insurance brokerages where you can shop through multiple carriers, right? Same thing with mortgages, right? I could shop through multiple lenders. We have over 220 lenders, so it just allows us for more flexibility to go lower credit scores. Maybe that client doesn't fit in that right box. It will, it allows for different things, so.
Got it. Okay. Cool, man. So you started at 18. You've been in the business, and how old are you now, if you mind me asking?
31 this year.
I mean,
so
31.
Yeah.
Started young. I wish I would have had someone in my corner that started me in that space that young. That's
No, it was honestly, I got super lucky. Lucky. I'm having the right mentor and everyone to get me in that space. And that's why I did a lot of my career. I did a lot of training, and kind of giving back that way.
Yeah. I had a guest on, agent from New York. Everyone is saying mentor. I had a mentor, right? I wish at 18 I had a mentor, like someone that was actually, there to mentor me. So that's great, man. So today, what we're going to talk about and discuss, I have past clients and current clients that own property, They
Yep.
some of them own investment properties already, and some of them are thinking about getting investment properties or vacation homes, second homes, stuff like that. And they currently have equity in their property. And I know a lot of people think that the equity in their property is like their savings account, right?
Yeah.
It would never go away. So tell us a little bit about um, this thing called a HELOC and explain
Okay.
to what that is exactly.
Yeah, HELOC, it stands for home equity line of credit. Okay,
Okay.
so it's basically a line of credit or collateral. It's basically you're putting a loan against your collateral for the difference of your current loan and the difference of the value, right? So typically HELOCs go from anywhere from 80% loan to value to 90% loan to value. So if you got, let's say, a home that has 50%, it's worth $1 million and you owe $500,000 on it, you can at least pull out, 300, 400 grand roughly.
Okay.
I'm going to tell you what I would use it for personally is property. Property's number one, typically, is to buy more property to make more money. Real estate pays the least amount of taxes, right? The more money you can make in real estate, the more money you can make, and it also makes more millionaires every year than every industry combined. So, a lot of times, home equity lines of credit are used for real estate to buy other real estate. Number two, projects. It is a lot easier to actually pull a HELOC and fund a HELOC in 5 days to 2 weeks than to do necessarily a cash out refi or a renovation loan. So a lot of people will do that to like redo their kitchens, things of that nature, pay off debt consolidation. But I always like to say is I like good debt. I don't like bad debt. Good debt makes you more money. Right. And so property. I would do property, second homes, investment properties, whatever buy more real estate. That's number one for me.
So, all right. So the HELOC is the home equity line of credit. A lot of people out there just is probably wondering, hey, if I do this HELOC, what's the difference between a HELOC and a cash out refi? And how does that affect my interest rate? If I have a great interest rate that I took advantage of in what 2020?
Well, that's the concept of the HELOC, right? It's the concept that you're not going to affect your first loan, right? It's a second loan that you're putting on your property. Okay. We're not going to touch the first loan. So if you got a 3% on your first, primary residence, let's say it's your primary residence, you have a 3% interest rate, that mortgage and that mortgage payment is going to stay there. It's not going to be touched. It would only be, it's a new loan that is separate from it for the equity difference out of it. Now, another reason why people would want to do a HELOC over a cash out refi is just a one-time thing a lot of times.
Okay.
HELOCs are not. You could pay it down and pull it back out and pay it down and pull it back out. You could reutilize it. So it's really good for investors to do maybe an all-in-one loan if they don't have any money on the property, or a HELOC. Maybe if they have a lot of equity position, to do a HELOC, because at the end of the day, that line of credit a lot of times is still going to be open even if they paid it off, right? They're not going to close that out, and they're going to have access to that money anytime. I personally like HELOCs because it's cash. It's cash on hand. Emergency happens, I can write a check tomorrow, right? I could pull money, from my house. Or if I come across a really good property on real estate, that's the best time to have a HELOC open.
Oh,
yeah. Now you can do your initial pull and use it for whatever and pay it off over time. That's usually what most people do. They do their initial pull, pay it off over time, and then once they have it paid off, they just rinse and repeat without having to go back to a broker every single time.
So
cash out, you can't. It's a one-time deal. You cash out, you're done. It's paid over 30 years. It's over. So
okay, in my understanding of a cash out, if I have, let's say we got $1 million property, I have 500,000 worth of equity in that property. I get 80%, let's say 300,000. I do a cash out refi for the 300,000. Well, yeah, for the 300,000 of the equity, right?
Your cash out refi would pay off the first loan. It's still the same amount of money that you'd get back out on a cash out.
Right.
It's not a, you're redoing the first loan. So like right now, this market, I would never ever recommend someone to do a cash out if
That's
they
my
got
point.
their loan 2 years ago.
Right.
Your interest rate's going to be like 3%, right? It'd be financially irresponsible for them to do that, right? Because if it's if they owe 500 grand on that's going to go up to 6%, 7%, whatever the cash out is, and cash outs usually have higher interest rates than normal refis anyway. So you got to keep that in mind: is what is my current interest rate, and does it make more sense to pull a HELOC, and what am I going to use it for? Am I going to make more money on whatever I'm doing, or is it going to be, am I going to get the reward in the end? Like, am I going to be able to redo my kitchen and still keep that 3% interest rate? Ideally, I would say, hey, redoing your kitchen with different money, and use your home equity to buy more real estate, because I think real estate more people should invest in real estate. So,
I mean, I agree with that.
It's probably my background. I'm a little biased, to be honest, but yeah,
it's all good. It's all good, man. So I'm just looking at and thinking about this. So if I have a cash out refi, let's say my current interest rate is at 2.8%, right? Because I did 2 years ago. I got the great low interest rate. And then I do a cash out refi and I'm like at 6.85%, but I get all those funds up front. I'm getting hit on that interest up front on all that money, correct?
Correct. Mm-hmm.
On a HELOC, I can do that same situation. Obviously, it's going to be a secondary or kind of like a credit card where I get a HELOC and I don't get charged on any of that money.
You don't necessarily have to. Now, there are some rules surrounding some banks when it comes to your initial draw. Sometimes you have to do your initial draw for 6 months, and then if you don't end up using money, just pay it off. Pay it back, and that way you're not paying interest every year on it. Kind of thing. But a lot of times they'll have rules on initial draws that you have to pull a certain amount of money on your initial draw.
Yeah.
But from there, besides that, you're correct. It's only money that you have pulled out of it. So let's say it's your second time around on property. Let's say you paid it off and you're going for round 2. Well, you're not going to pay interest on that loan until you pull that money. You already have it in place.
Right.
I talk to people all the time. They're like, hey, I want to refinance my house. I have a HELOC paid off, but I don't want to close out my HELOC, because they want that money available if they have it and they don't want to redo it.
Banks have to hate this.
Yeah, sometimes. Yeah.
Most of them. They're setting money to the banks like to make interest on their money. So they're setting this money to the side for one particular person.
Yeah. It is it's just it's an amount available for them at any given time. And that's what I'm saying. Like there's people that will use it as 6-month reserves, or all sorts of different reasons. But like I said, at the end, it's for me, it's I always lean towards, if you're going to pull debt, make sure it's good debt, not bad debt, and make sure your money's working for you. Start an Airbnb arbitrage business, or do something with it, or Airbnbs, or rental properties, whatever it is.
And I mean, in this situation, so let's say we do a HELOC, right? Mm-hmm. Let's say we do a HELOC. You said it could take 4 to 2 weeks for the deal to fund, right? I don't necessarily have to pull from that HELOC right away, right?
Sometimes you do. Sometimes you do. It depends on the lender. Okay. Some lenders won't give you a higher line unless you do pull it from right away.
Got it.
Now, here's the thing. They fund within 5 days a lot of times. These aren't like normal loans. They're right. It's not like the mortgage process where it's, you have a purchase contract, you're doing jumping through a bunch of hoops. You already own this property. You already have a first lien holder. The HELOC already knows they're going second position, so they're not going to have to argue with the first bank or pay off the first bank or even deal with the first bank,
right?
For the most part, so it's usually a very quick process. So I don't tell people, don't worry about it too much in the terms of having that money initially. Look for that property. Right? You can get pre-approved all the way through, and they can say, hey, here's how much I'm pre-approving for you. And you don't have to pull that money. You can just wait. Just wait, because it's going to fund within a few days anyway, once you decide to sign the, final papers. So you could start the process, go all the way through it, put it together, get pre-approved, just like you would with your purchasing a house, right? The same thing with a refi, a HELOC or doing a refi is you can go through, get pre-approved all the way and say, yeah, you'd qualify for X amount of dollars on a HELOC. And here's your today's rate. And then you could wait until you find your property that you're looking to buy, right? Because typically it's going to, even on cash deals, they close faster than most cash deals. So,
so what if I'm in terrible debt, in a terrible debt situation? I need money to pay down, let's say, credit cards or whatever. Can I do a HELOC for that?
Yeah.
Okay.
Absolutely. Yeah. So you can do HELOC, paying off debt, get rid of debt. A lot of people are like, hey, how do I get in the investment game? Maybe I don't make enough money. There's DSCR loans that you can pull HELOCs out for and then turn around and buy a DSCR loan, which we don't use income to qualify. It's based off the property and what it would rent for.
Okay.
But yeah, I mean, if you're looking to trade out debt of, I still call it bad debt because no matter what, it's bad debt, if you're not making any money off it.
Right.
But if you wanted to go out, and I do absolutely recommend doing it as well. If you wanted to pull HELOC out, let's say, and pay off $30,000 in credit cards at 20% interest, or 25, 29, whatever it is, your HELOC's interest rate's not going to even be close to that.
Yes. And that's the benefit, right? Because majority of credit cards are at 20, 25%. So the HELOC, what are we looking at? I know we can't say it's going to stay around
like 9%. They're adjustable rate. They adjust with the market though, 9 to 10 usually. And it's about 2 or 3 points up front. So whatever it is. So let's say you're pulling $100,000. So looking at closing costs about $3,000 roughly.
Gotcha.
We don't, and the banks do this on purpose. They don't know how long you're going to keep it. Exactly what you're saying. Banks hate it. Right? Because they don't know if you could turn around and just pay that thing off and just keep it on an open line of credit.
Right.
So there is usually some origination, charged with it. But with that being said, that allows them to say, whatever, pull your money, don't pull your money, do whatever you want, do your initial draw, pay it off. Don't care. They made their money. But with that being said, it does allow you to restructure debt to buy more property, maybe in a traditional way. Maybe it just puts you in a better financial position. So on and so forth. I wouldn't recommend doing it with anything other than really credit cards or high interest loans. Cars, things like that. Cars, you can usually get a lower interest rate.
Right. So mainly more for like the credit card situation, if you're in that position where you need to take advantage of it. Now, let's go to ask you this question. Now, I have investors that own multiple income properties, right? They own 40 to 100, kind of like your situation.
Yeah.
Can I do a HELOC on an income producing property or income property?
Yeah. Wow. Investment property? Yeah.
Yeah.
Absolutely. There's HELOCs up to 80% on those. Yeah. HELOCs have become a lot more popular for a reason. If you look at the last decade, interest rates have really my entire career, interest rates have really never been over 4%, 3%. So HELOCs really didn't make sense. You could just cash out refi and, call it good. A lot of times spread that payment over 30 years.
Right.
And take your money and do whatever you want with it. Now with interest rates higher, it makes a little more sense. So companies now have come out with investor HELOCs, or HELOans, is what they call it. And to where you can go and take an investment property. They don't typically let you go over 80%, loan to value on those, where on a primary residence, they'll go over up to usually 95 or 90%.
For the HELOC?
Yeah, for the HELOC on a primary. Wow. So if you owe 50%, you can pull 45% out or 40% out roughly. Depends on the bank. And the credit score and rules. It's going to depend on the client's profile more than anything. But on an investor, I can almost guarantee it's only 80% a lot of times or 75%. But if that investor doesn't want to mess with their loan, let's say they got investment properties that, are strung out at 4% or 3% or whatever it is at the time. Yeah. And they need the capital because that's what a lot of investors do. They, the BRRRR strategy or whatever they did, right? to get where they're going, they could throw a HELOC on that, pull the equity out, and then continue to buy and continue to build their portfolio.
Got it. So, all right. Is that on one property, or can they do that on like a portfolio?
Like a blanket?
Yep.
Usually one property on HELOCs. Now, there are blanket loans out there, but typically most banks that do blanket, they want to pay off the initial mortgage. They want to pay it off.
What if I own them outright?
Maybe I'd have to look into it. Honestly, I haven't blanketed HELOCs on investors, but it's possible.
Okay.
It's not. I wouldn't say it's not possible.
Fair.
It makes sense. You could. The problem would be is they would still have to evaluate each property individually to find out how much equity is in each equity position and pull it out. You need to do that in blanket though anyway.
Yeah. I don't know if they would want to do a HELOC on. Well, I guess they probably.
I do have DSCR loans that are blanketed packages though.
Okay.
So like, and if you have an investor that wants can't qualify for 8 units, right? I can use no income on 8 units. If they want to buy 8 units at once, I don't need a job at all. They just need the down payment. So we could HELOC them individually or pull the money or see how much money we need to pull out of each one individually and then go and turn around and buy 8 more, as a package if you wanted to. We could do packages that way. I don't know about specifically HELOCs in the terms of blankets.
Yeah, I want to circle back to that because that's a good one because I got a couple investors that own multiple properties. So I like that. I like that idea.
Yeah, they could always refi those as well. So, but it just depends on their interest rates. Like how much money are they going to obtain or earn off the money they pull out versus what is the interest rate on their current properties. If they're in the 6s or 7s, it's not going to be as big of a as a deal as to. You're not going to want to do an adjustable rate HELOC. You'd rather do a blanketed DSCR loan that's a fixed rate. Fixed rate's still going to win, be king, over that a lot of times. Also in DSCRs, we can do interest only. If we're trying to increase our cash flow, there's a lot more options with those on refis than necessarily going out after a HELOC. HELOCs a lot of times will have some sort of payback plan,
Yeah, and that was my next question. So basically, in the HELOC, what I've heard, maybe you can correct me if I'm wrong. I'm sure they got a couple HELOC programs out there, but with the HELOC, you have up to 10 years on average, 10 years to draw from that HELOC, correct?
Usually 10 to 20.
10 to 20.
It's shorter.
Then you have around 20 years to pay that HELOC off, the original one, correct? You can do some 30s.
It depends on the type of HELOC. So, for example, the all-in-one loan is technically a HELOC. It's a very special loan type that's simple interest.
I like that. I watched that video on that. That all-in-one is nice. But go ahead. Sorry.
But that one specifically is $65 a year, and you can keep your HELOC forever.
That's beautiful.
So it's not. It just continues going. Continues going out, or up to 30 years. Right? There's a term. There's an extra term with it. But I would say most HELOCs, probably 10 years. Probably exactly what you said.
Okay. So if I'm a normal person buying a home, I live in this home. I plan on living in it for 30 years for my mortgage, right? My concern of doing a HELOC is the fluctuation of the
payments.
The HELOC, the payments. So am I locked in at a certain like that 9%? How long am I locked in at the 9% before it goes up?
It depends on what you pick. So typically HELOCs will give you 3 or 4 options, right? When you're given a HELOC, each bank will be like, all right, hey, do you want a lower interest rate starting out with like a 2-year fixed rate, and then it will adjust from there, or some do like 3 years, 5 years, adjustable rates. And some say, hey, I'm just going to take the adjustable rate right out of the gate so I can get the lowest rate possible, or whatever it is. So again, it's not, it depends on the situation and how much that cost is and how much money that gives it to them. There's a cost analysis with all of this. Any mortgage lender that you're working with have to run a cost analysis. Like if you're not working with a mortgage lender that just says, hey, I'll give you a 9% and call it good, you're not really helping that client decide what they need to be doing financially with that money.
Right.
You're going to run a cost analysis. You're going to say, okay, do I want to take a 2-year, option where it will adjust after 2 years? And then how much will it adjust? Will it adjust up to X amount or this X amount? And then how long do they think they're going to keep that, HELOC open for? Number one. Okay. And then number two is, what do they plan on doing with the money?
Right.
That last one is going to be the most important.
Okay.
At the end of the day, it can go the opposite direction too. Most likely, interest rates are going to drop over the next 2 years. When inflation gets taken care of, the bond market, when there is more confidence in the U.S. economy, naturally interest rates will drop. And when inflation is high, a lot of times the Feds will hike the rates up to try to offset the inflation of the U.S. dollar. When we take care of that piece, you're going to see our rates start to dip a little bit.
Okay.
So I don't think over the next 2 years, people are going to really have to worry too much about adjustable rate mortgages. Personally, and this is a personal opinion, opinion of mine, not my company.
Disclaimer.
Yeah, disclaimer. But for me, I wouldn't worry too much about the adjustable rate. Now, also a personal opinion, if we decide to waive all the student loan debt, there is more, there's consequences to all, stuff like that. So
yeah, what happens in that situation if you pay off your student loan?
Money has to come from somewhere. So money has to come from somewhere. So if the U.S. government decides to pay off all the student loan debt, the money does come from somewhere. So yeah, but but again, when you're looking at it, usually student loans are very low interest, right? They're very low interest. It's not something you'd ever want to pull a HELOC out for, especially if they're talking about forgiving it, stuff like that.
You want to kind of steer away from that. So tell me this. I have I have past clients and current clients that they don't have any idea what a HELOC is. You explain that a little bit more in detail. It was kind of concerning about the fluctuating of the interest rate, right?
Mm-hmm.
But I answered that question that, hey, in 5 to 10 years, hopefully, interest rates will be down. We can just refi out and pay off that.
Well, on it will fluctuate down. The rate would fluctuate down.
Oh, okay.
So it's not gonna, when it goes, adjustable rates. A lot of people they worry about it always going up, but they don't continue. They don't talk about how it goes down too.
Okay, so it does go down.
Yeah, it goes down. It fluctuates in the market. Mm-hmm.
Okay, and in this situation, if I have a mortgage, I'm currently at a 3.54%, right? I decide to do this HELOC, this secondary loan per se. What does it look like as far as what are norms for credit scores? What are you looking at as far as credit scores? Do I need to be employed? All that good stuff.
On HELOC specifically, yes, you have to be employed to do traditional income verifications. Okay. So that's going to be your W-2, pay stub, self-employed, looking at taxes kind of deal. Okay. So a lot of times, investors will be capped that way on it because the way we, as self-employed, part of the game is not paying taxes, right? That's why real estate is so lucrative, because you can pay less taxes.
I pay my taxes, by the way.
Yeah, we all do. Yeah, anyone listening. But with that being said, they're traditionally qualified off income. And just like any other loan, they grab your pay stubs, grab your bank statements, whatever it is, and they qualify based off that.
What are we looking at, like credit score wise? I know.
Credit score wise, 640.
640,
somewhere around there, 660, 660, probably closer.
I know, because we were talking earlier on another show about you can qualify people at 500 credit score.
Yes, so that is FHA. So, like for instance, if someone wanted to cash out of their primary residence and they didn't have a great credit score and they wanted to do XYZ with it and pay off all their credit cards, which most likely will boost their credit score, by the way. Yeah. But if they did that, we go down to 500. FHA technically goes down to 500. Now, cash outs, a little bit harder to get. You probably want it closer to 580, right? Anytime you're giving money to someone, that's where, they're like, okay. Yeah, the banks are a little more stringent. Right. But on purchases, absolutely, they go down to a 500. So you're looking around 580 though on a cash out for FHA.
And do you have any successful like stories of people using a HELOC and basically coming up in a down market or even a normal market like this? Have you seen any situations where people take advantage of that HELOC to purchase income properties?
We have 7 this month that we're doing. 7 this month where I have I'll give you an example. Some people pull HELOCs and know that it's just going to be short term just so they can purchase a house cash. So for a lot of real estate agents, right, it's like, hey, I have it, but I'm in a market where I don't want to sell my house. I have it free and clear. And then I also want to maybe I'm downsizing, or maybe I'm moving from California to whatever, or maybe I'm moving from my house that's $2 million to a condo that's, $100,000, $200,000, $300,000, whatever it is. But I don't want to move, and I don't want to, and it's a super seller's market, and I know I'm going to sell my house within days, but it's going to be hard for me to buy a house. Right. HELOC. Pull out the money, buy the property cash, sell your house, move and move. Very quick process. Allows your real estate agents to get a double side sale and not hold up the transaction because they have the equity position. A lot of times people will use bridge loans if they don't as well. So there are bridge loans out there as well to do the same thing. But typically, if they have enough money to buy that house cash and they don't want to leverage that money for whatever reason, you can go and just purchase that house cash and then talk to them about, hey, what are you going to do with the rest of the money? Are we going to buy investment properties? What's our goal? Like, what are your goals? You trying to retire sooner? You're trying to be a multimillionaire because real estate builds the most millionaires in every industry combined, whatever you want to tell them. Right.
So what if I want to be a crypto king? Can I take my HELOC money and put it in crypto? And
yeah, it's your money. I don't care what you do with it. You can pay your back taxes too if you want. So I don't care. I don't, but I personally, again, personal view is crypto. And this is a guy I did buy crypto a long time ago, and I had about 2,100 Bitcoin at one point, and I sold it for a $2,000 profit. And this is years ago.
Yeah, I mean, it had been like very low.
Yeah, it was super low. Okay, I only bought it for a few grand or something like that. Okay. I can't remember what it was.
Okay.
If you want to play that market, go for it. It's just not a market I play in. I personally, it's all real estate related.
I love real estate.
It's not. Time and time again, I have been burned on trading. Trading. So I went to. I bought courses. I've gotten mentors with trading. 95% of people lose money on trading in general.
Yeah.
I just think real estate is just so more stable and lucrative, right? At the end of the day, because when you pull your money from your crypto, look at your tax rate on that. On that money, it's a lot harder to hide.
So you're right on that. So let me ask you this: as far as obviously people are looking at. I think the HELOCs are starting to get more and more popular right now with the interest rates being so high. What would you give advice on? What would you say? Would you pay off your mortgage, or would you keep a balance in your mortgage? That's just an offer.
I would keep it balanced always.
Why is that?
I can use the money. I use money for something else. So good debt always. Mortgages are typically good debt. Your personal house, not so much, right? You are getting an equity position from it, but you're paying into it. Right. But good debt would be investing in property, investing in Airbnbs, investing in whatever, condos, you name it. Debt is king. I feel like debt is not taxable. It's actually something that you can deduct. That is a big portion of real estate. And I think you should leverage yourself as much as you can to buy as much property as you can, because the more debt you have, the more interest you can write off. But also the more money you can make, because typically you're going to have a a higher margin on your rentals, as long as you keep them up and do the
I'm
normal
gonna get you a
thing.
shirt. I'm gonna get you a shirt, a printed shirt that says "Debt is King."
Yeah, debt is king.
That's your new slogan. Debt is king.
It is. It really is though. I try to explain this to clients all the time, and they don't understand. It's like they want it the traditional where mom and dad brought you up is you buy a car, you buy a house, you get married, you pay everything off the Dave Ramsey way, and things like that. And
you live it.
I am turning 31 here in 5 months, roughly. I don't think I'm going to have Social Security. I really don't. I don't think I'm going to have certain programs. It's going to
I think you're right. I think I won't either. I'm 10 years ahead of you.
So I am constantly thinking about how I'm going to, retire. At the end of the day, if I die with $100 million in real estate debt, there is death insurance for mortgage insurance. There is a thing out there. Right. I do carry it on. I would recommend to carry it always. So if I kick the bucket for any reason, it's all paid off. Those properties are going to go into my trust. There's other things you can do, but this goes to family, right? I'm not going to get into the whole tax thing, but you can get into trusts and different things. But that stuff is going to go into deeper pockets, and it will continue to go on as long as they don't screw it up,
Yeah, we actually have a next week on our show. We're having a trust specialist come on.
Yeah, I 100%. I'm a trust guy, so I would.
I'm with you on that too.
So debt is king. Keep as much debt as you can on you. Constantly pull out. I'd be pulling out my money all the time to buy as many properties as you can. And then you get to a certain point, is like, okay, time, effort. How much time do I want for effort for the properties we own? And then you're at a point where it gets real fun. It's like, how can I reduce my time and still make the money I'm trying to make and live the way I want to live and do the way I want to do? I enjoy doing mortgages. I enjoy what I do. But I've also in the last 3 months been to Thailand, Guatemala, Colombia, Jamaica.
Man, you've been all over, man.
Yeah, so you name it, or Japan, I guess.
You must not have kids yet. 31?
No, got 2 kids.
Oh,
2 kids. Yeah, 10 and 11-year-old. So I started real young. I started real young all the way. Yeah. So
all right, Jordan. So let me ask you this: where can people find you at? I appreciate this time too. Thank you for being on here. Where can I find you at? Where can I find you at on social media or period anywhere?
We have a business Facebook page, so we run a team. Okay. So if you look up VMP Virtual Mortgage Partners, you can find us on Facebook. I have my contact info on there as well. And then I can also drop you my contact on my personal phone number as well if anyone wants to get a hold of me on my personal cell. I usually give out my personal cell more than anything.
Okay, but I'll put it in the YouTube comments, all the social media comments, all that stuff. But it's called V as in Victor. Mortgage.
VMP. So Virtual Mortgage Partners is the team we run, and it's at Nexa Mortgage.
Gotcha.
Mm-hmm. So you can always go to virtualmortgagepartners.com. And that will be our team's website. Got
it. Awesome, man. So as always, I appreciate everyone joining today. Jordan, thank you for coming on the show, spending this time with us. I look forward to hearing from you in the future. Obviously, we got a couple other things we're talking about offline. But great stuff today, man. So I appreciate you getting on.
Yeah. Anytime. I appreciate it. Thank you for having me on.
All right, man.
Have a good one.
I'll see everyone next time.